Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 31st, 2022. We are in the absolute last day of 2022. Wow, what a year this has been in the market. Quite a bear market, been a tough market. Hopefully we'll have some better things to come in 2023. We will see. Hope you're doing well. Hope you're having a good day, and appreciate you coming to my weekend review of the trades that I took last week. And in this podcast today, the format is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frames, the weekly time frames, and the monthly time frames. I'm a big fan of trading multiple time frames. I think it tends to help even out and get a good cross section of the market. Ideally, I mean, my trading philosophy is trading multiple time frames, multiple markets, and multiple strategies, multiple setups. And that's worked well for me over the years. So we're going to take a look at all the trades, why I entered them, or when I entered them, why I entered them, and most importantly, how I am going to manage the trade going forward based upon my trailing stop rules, based upon my end of day stops, based upon my emergency stops, my partial profit taking, all the things that I do in my process of trading. So we'll go through all of those. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to control your emotions, the ability to create a plan and then follow through on that plan based upon your process. So we'll spend a few minutes there. After that, always like to cover one of my friend Frank's poems, The Trading Poet. He's a great trader. He's a great author. He's a great journalist, and he can write one heck of a poem, and it's regard to trading, and it's always pertinent. So we'll take a look at that. After that, I have gone down through my watch list, my master watch list, and I have picked out some trades for next week that I am interested in taking. Usually, the price has to go down to find some support lower, or it has to go up, create some kind of momentum. And so I've gone through and I have identified both on the daily charts and the weekly charts what I'm looking for next week. So hopefully that's helpful for you to kind of get an idea of how I look at trading, how I look at support levels, how I look at position sizing, and that's what we'll get into. So hopefully that's helpful. So first of all, I'm going to run the U.S. legal disclaimer, and I will be back in about 40 seconds. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. I want to start this out. This is not a trade that I took. It was something, if you've been watching the podcast, you'll remember that I have pointed out I did not take this trade for whatever reason. I look at this and go, why didn't I take this trade? It was perfect. But one of my one-on-one students, Jean, just wanted to congratulate her on this because I've been in contact with her the last couple days on this trade. And boy, this trade has a lot. There's a lot of confluences, combinations of indicators and entry triggers lining up here, and I just wanted to go ahead and show you this. This is CNCE, Concert Pharmaceuticals, and the first thing I want to point out here is that we have a beautiful double bottom and a bullish divergence. And you might ask, well, what is that? Well, a double bottom and a bullish divergence has to do with momentum and MACD. And the rule is, first of all, we have to make a low, then we have to measure the depth of the MACD bars, or measure the momentum. Well, we came down here. You can see the red bars. This is what indicates the downward momentum, pretty deep bars. So that's requirement number one. Requirement number two, we have to rally into some green MACD bars. And then we have to come down and we have to either test the low or go lower. And then we have to identify the depth of the MACD bars. Well, you can see this first rally, or I'm sorry, not rally, but this first sell-off here had very deep MACD bars. We did rally into some green, and then we came back here about the 7th of December. We did go lower than this particular low, but you see how shallow the MACD bars are? Well, that indicates that the momentum is waning, or in other words, that we're running out of sellers. So this is what I learned from studying with Dr. Alexander Elder, and they're great setups. He seems to think they're the strongest technical setup in the markets, and I would have to agree, but they don't happen all the time, but it did happen here. So you can see this first low, deep red MAC bars, we rally to some green, we come back, we test this low with shallow MACD bars. That means that momentum is waning, and the implication is it would go up, but you still need a trigger to get into the trade. Well, the trigger here was this intraday rejection of the 300 SMA. You see how we went down during the day and then we closed above it? That is simply the trigger, especially, that would be a trigger anytime, but especially in conjunction with this double bottom and a bullish divergence. So she bought here when it rejected the 300-day moving average. Now, of course, I would place an emergency stop 2 ATRs below, and her end of day stop would simply have been a close below the 300 SMA. Well, you can see it rallied, it came back down, it went under the 300 again, closed back over, so it kept her in the trade. And then look at this beautiful move up. And this particular trade, entry from exit for Gene, approximately 25% in the last month. Isn't that amazing? So these are the things that I teach in my private one-on-one lessons. I do offer a course. It's 15 hours one-on-one, 5 sessions. Each session is 3 hours. And I teach you all of these different setups. I have 5 different setups that I use that I've learned over the last 28 years as a professional trader. And this is a really good example of one of them. And I just want to congratulate Gene on this great trade. And I will talk a little bit more about my lessons later in the podcast. But if you are interested, all you have to do is reach out to me. My email is in the description of this YouTube video. And just reach out to me. I'll reply, and we'll talk about the lessons. And it's a great course. It's a great course. I've taught people from all over the world. So beautiful trade, Gene. Really beautiful. Congratulations. And I hope that keeps going. We're at 68.49. Hope that can get up into the 70 RSIs. Of course, she's been taking profits along the way, but congratulations. And a beautiful example of a double bottom bullish divergence and a trigger with rejection of the 300-day, and that has been a monster trade. Okay, let's get over to starting with my trades for the week. And this is MasterCard. I did buy MasterCard back here on the 20th of December. Very similar to Gene's trade in that it rejected the 300-day moving average. Did not have a double bottom bullish divergence like hers, but nonetheless did buy here at 342.70. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. And my end of day stop would simply have just been a close below the 300 SMA. So bought here 342.70. Initially, next day it did go up. I took a little profits off. Whenever you have the previous day's close, if it moves the value of 0.45 ATRs from the previous day's close, I always take 10% off. I always like to take something off when the market gives it to me. Not the entire position, but I like to take something off. That's the offensive part of my trading. The trailing, the emergency stops, the end of day stops, the trailing stops, these are all defensive moves, but the offensive move is taking partial profits when the market gives it to me. So my end of day stop is a close under the 300 SMA. You can see the next day did go up, took some profits. The next day looked bad it was below, but I based everything on the closing price. That's the most important price, in my opinion, is based upon the closing price. And it did recover and close back above, so I kept the position. Next day, gapped lower, but by the end of the day, held the 300. Then we moved up, took a little bit more profits here, took another profit target here, and down a little bit on Friday, but still profitable on the trade. This particular trade from entry to current price is up about 1.43%. Okay, let's get it to GDX. Well, GDX, I don't do a lot of short trades, but this was a short trade, and I did short GDX back here on the 29th of December at 28.94. Why did I do that? Well, you see the downward sloping 200 SMA. Well, that's a very strong level of resistance, well, of support and or resistance, but you can see we closed above, closed below. That would have also been a legitimate entry. But then on the day that I took it on the 29th, you see how we poked our head above the 200? There were no more buyers up there. And then it closed below. So I did short here at 28.94. I placed my emergency stop 2 ATRs above. And my end of day stop, because this is short, is just simply a close back above the 200-day moving average. You can see since I shorted it on the 29th, it has moved down. I did hit a profit target on Friday near the lows, 10% profit target. But simply if it closes above the 200, I am going to be out and take a loss. But currently, this particular trade here is in the money, 0.94%. And in addition to that, I just talked about the double bottom with the bullish divergence with my student Gene's trade. Well, now we have a double top with bearish divergences. We've come up here, we've had strong MACD, we've pulled back, we rallied back up, but no green MACD whatsoever. So this is showing me that we are potentially running out of buyers, and the implication is that we would be moving down. And so that's simply the trade right there, up 0.94% on the short position. Apple. All right, I did buy Apple on Thursday, the 29th of December, simply when we had an under 30 RSI reading and then a close back above. In addition to that, we also had a close under the negative third ATR channel and close back above. I'm not going to take a trade just based upon a close over the third ATR channel, but it does add some supporting credibility to the trade when you have a legitimate entry signal like an under 30 over 30. That's a deep dip buy signal. And then you also have an under the negative third over the negative third. And then in addition to that, I do like that we, on the higher time frame on the weekly, I do like that we rejected the the second negative ATR channel. It showed that it did have some support here. I like to look at multiple time frames to look for multiple levels of support. If I take the trade on the daily, I need to have a legitimate entry signal like an under 30 over 30. But big picture, I like to look for some kind of rejection of some kind of level. And the negative second ATR channel is definitely a level. As a matter of fact, 88% of prices tend to stop going down at the negative 2 ATR channel. 92% of prices tend to stop going down at the negative third, and that's why I like that one better. But nonetheless, it still did show some good support on the weekly by rejecting the negative second ATR channel, big picture, and then on the daily with the under 30 over 30 as my entry signal. And then my emergency stop is 2 ATRs below my entry. and my trailing stop level is 1.5. So if we get up to the trailing stop level, then if I get a close below a previous bar's low, I will take half the position off. And then I have other rules in case we reject the 70 RSI or we get above the 65 RSI and then we close below the 5 EMA. But these are all the rules. These are all the things that I teach you in my one-on-one courses. I'm limited a little bit by time here. I mean, each lesson is 3 hours. So here, this podcast is only about an hour, so I can't really get into the nitty gritty of it. But that's the trade so far. And bought that on Thursday at 129.50. Opened lower, went lower. Trade was not looking good. By the way, my end of day stop would just simply be a close below the 30 RSI. Okay. But we had a nice rally towards the end of the day, and this actually turned green. So this particular trade up, not a lot, but 0.35%, and was really glad that it recovered towards the end of the day. So again, if we close below the 30 RSI, I will be out. If we hit my emergency stop, I will be out immediately, regardless whether it's the end of the day or not. If we get to trailing stop level, then I go into trailing stop mode. So I believe that's all of them for the daily. Let's switch over to the weeklies. Okay, so I've been in this trade for quite a while. This is IWM. This is the Russell 2000. I did buy this back here on 1014, very similar to the trade that Gene had. And it's actually extremely similar because I was talking about double bottoms, bullish divergence. Well, look at the bottom over here with the MACD readings, pretty deep. We rallied into green. We came back. We tested the low, and the MACD bars are more shallow than these are deep here, indicating a lack of momentum to the downside, and the implication is running out of sellers, and the implication of that is that we're going up, and that's exactly what happened. So I did buy back here on the 14th of October at 167.19. Place my emergency stop 2 ATRs below. Simply a close below the 300 SMA, I would have gotten out. Well, it moved up nicely, moved up to my trailing stop level 2 weeks later. Of course, as it moves up, I always take those 10% partial profits when it moves the value of 0.45 ATRs from the previous bar's close. So took 10% off here, took 10% off here, took 10% off here. Trailing stop level 4 weeks ago. It did have a close below a previous bar's low after reaching trailing stop level, so I took off half of the position at 178.70 and locked that in. Now, going forward, if it continues to move up, I will take 10% profits based upon adding this is the weekly close, add 450 to it. That would be my first profit target. Take my first profit, add the 450 again. That's my second. Take the second profit, add 450 again. That would be my third. So these will just be standing limit orders, excuse me, in the system if it moves up. Now, if it moves down, what was my entry signal? Under the 300, over the 300. So if it simply closes below the 300, then that will be the end of the trade, but most likely it will still be a profitable trade because of the partial profits I took on the way up, the trailing stop level that I took with the close below previous bar's low after reaching trailing stop. So that's locked in. The market can't take it away from me. And I think it's very important in trading that you trade both offensively and defensively. And again, the profit targets, that's the offensive moves. The trailing stops, the emergency stops, the end of the day stops are the defensive moves. So on the remaining position that I have on this trade, it is currently up 4.1%. Microsoft, same. Bought this back here on 11.4 with a bounce at the 200-week moving average. Place my emergency stop, which is 2 ATRs below. My end of day stop or end of week stop in this case would simply be a close below the 200 week moving average. 1.5 ATR trailing stop level up here is where I go into trailing stop mode. Next, after I bought this here, 221.34, it moved up strongly. I hit 2 profit targets, so I took 20% off of the trade on that big move up, got to trailing stop level. Then I'm looking for a close below the previous day bar's low, hit another profit target here, hit another profit target here, thankfully, before it reversed back down. In these kind of markets, it really shows you why taking these partial profits is a great idea, because you're taking it off at profitable levels, but then if it reverses back down, then you have fewer shares, so you're mitigating your loss. So last week we finally had a close below a previous bar's low after reaching trailing stop level. I locked in half here at 239.50, locked in half for a profit of approximately 7.28%. And going forward with the remaining shares here, it's either going to keep moving up, in which case I will take partial profits again, or it will close below the 200, and that's my end of day stop. Now, we do have earnings out here on the 23rd of January. I do not hold through earnings on any of my positions. I think it's a really good, it's a great way to make a lot of money quickly, but it's also a good way to lose a lot of money quickly. And in trading, we want to work with the latter, right? We want to avoid any position or any situation where we are going to have the ability to lose a lot of money. And holding through earnings, either one can happen, but I think it's better to be safe in case earnings are not what they're expected, or even if they are expected, the market may not like it either. So this particular trade, the balance that I have currently up 7.5%. So nice trade there. Joe is coffee. And I did buy Joe here with a confluence combination of indicators back here on 11/18, where we went under 30, over 30. That's one valid signal. And we also bounced at the 200-day or 200-week moving average. So it gave me a confluence combination of indicators lining up. As always, I take my maximum allowed loss, which is generally 1% of my account. So if you have a $100,000 account, 1% is $1,000. I take $1,000, I divide it by the value of the 2 ATR. That tells me how many shares to buy. And then I also put my emergency stop down below exactly that amount, 779. And so if it does come down to my emergency stop, it may be 10-15% away, but it doesn't mean I'm going to lose 10-15% of my account. If it, because of the position sizing that I use, if it does get down there, then I've only lost 1% in the worst case scenario. And then my end of week stop is just simply a close below the 200. These emergency stops don't happen very often. About 95% is what I have noticed that your end of day stops what you'll have, but only about 5% of the time you'll hit your emergency stop. But you do hit them sometimes for sure. So that's why it's important to position size using current volatility, taking your maximum allowed loss, dividing it by the value of the 2 ATR. That takes all of that into account. It shows you exactly how many shares to buy, and it's a really nice way to position size. And not just position size correctly, but position size based upon the market volatility. So I did buy it here at 44.28. It has moved up. I did take some profits here on this week, took 10% off of those profits, took another 10% off the next week at profitable levels. Here's my 1.5 ATR trailing stop level. Have not reached that yet. Once I reach that, then I go into trailing stop mode, but I don't go into trailing stop mode until I reach that. Anyway, still doing well. The current P&L, or the current profit on this, 7.5%. Not too bad, right? Not too bad at all. So we'll see what happens. Of course, if it closed below the 200, I would get out, hoping it doesn't do that. Obviously, hoping it goes up to my 1.5 ATR trailing stop level, and then I go into trailing stop mode. Google. Okay, I did buy Google here with last week at 88.90. And the reason I bought it was because of the rejection, the weekly rejection of the 250-week moving average. It also came at a higher low. This would have been a valid signal back here with the rejection of the 250, and there was certainly some opportunities for some profit in there, but I like higher lows better than lower lows. Lower lows tend to bounce and then fail. Higher lows tend to give you the opportunity or increase the chances of having a nice leg up. And so you can see when this rejected the 250 here, this came from a lower low situation, but this rejection of the 250 came from a higher low. Here's a low, but it's higher than this low. Okay, so I did buy here 88.90. I position sized using the 2 ATR. My end of week stop is simply a close below the 250. Up here is my trailing stop level, 1.5 ATRs above. During the week, it was down. I thought, probably going to have to get out of this trade if it closes below the 250, but it did recover. So far, that 250 is holding, and it is above. It did close on a weekly basis above the 250. Now, this particular trade is down a little bit. It is down about 0.65%, but it recovered nicely on Thursday and Friday's rally. Friday rallied at the end of the day. Believe it was still down on the day, but still a nice comeback. So this particular trade down 0.65%. Tesla, ooh, the mighty Tesla, my gosh. Well, I was waiting for Tesla to do this, and it did it. Tesla has just really got annihilated here with all the news with Elon Musk and so forth. But the 300 week moving average is what I was talking about last week on this podcast. If it closes below, if it goes below the 300 and then closes back above, then I would be entering the position. It also had a V1 entry. Here is bar 1. Here is bar 2. Bar 2 goes below bar 1's low and then closes above bar 1's close. So I'm not going to take the trade just based upon the V1 or V2, but in conjunction with the rejection of the negative, the 300 week moving average and the V1, that is my entry signal. And by the way, a lot of people ask me about V1s, V2s, and I do have a video on my YouTube channel. It's in the lessons playlist about V1s and V2s. It's completely free. It's in the description of this video. The link is in the description of this video. So go ahead and check that out. I think you'll really like it. I love V1s, V2s. They really do add some credibility to any trade. And in my one-on-one course, I have two V1, V2 strategies that are specifically for only V1s, V2s, but they still can be used in conjunction with other signals like the under 300, over 300. So I just want to take you through on this. I was talking about position size. Well, let's just say that since I did just take this trade on Friday, let's just go through and do a dry run of exactly how I would position size. Okay, let's just say I have a hypothetical $100,000 account. 1% of 100,000 is $1,000. I would take $1,000. I would divide it by the value of the 2 ATR. This is on the weekly, so this number is going to be higher. 54.61. So 1,000 divided by 54.61. I would buy 18 shares. Not a lot of shares, but there's a lot of movement on this stock. And then I place my emergency stop 2 ATRs below. So if 13 shares moves $54.61, there's my $1,000. Now this is 30-40% down, but I still would only lose 1% of my entire capital in the worst case scenario generally. But my end of day stop is simply going to be, or my end of week stop next Friday, if it closes below this 300, I will just go ahead and get out, right? Just take a small loss, hopefully, and get out. But in the worst case scenario, I already know what my maximum allowed loss is, and that's a nice feeling. So this particular trade up a little bit. Let me switch to the dailies here. This trade up 1.64%. So far so good. And boy, if you're waiting to buy Tesla, as I was, this looks like a good level. But more importantly, it just gives me levels to work off. I buy the right amount of shares. I know what my emergency stop is, and I know right when to get out if we close under the 300. And if it does, I'll just go ahead and get out. And in the future, if it closes back above, I can just get back in, right? Okay, so there's Tesla, and here is Intel on the weekly. Now, this is a really good example. I had a lot of high hopes for this particular trade. It ended up with a loss of 6.5%. But the reason I had high hopes for this, there were so many confluences and combinations of indicators lining up on this trade. Let me point them out to you. So at the end of the month, at the end of October, we went under 30, over 30 RSI. Just that by itself is a legitimate entry. We had a close under, close over the 200. That's also great. We had a close under, close over the negative third ATR channel. That's wonderful. And then we had a V1. I was just talking about V1s, V2s. Here's bar one, here's bar two. Bar two goes under bar one's low and closes above bar one's close. So we had multiple signals here. But it just goes to show you that even if you have the best potential setup in the world, it doesn't mean it has to work. So I bought here at 28.21. The next month it went up. I did take some profits because it moved 0.45 ATRs from that close. So I did take at least 10% of the profit off before it headed back down. I took the trade because we went under 200, over 200, and yesterday, the last day of the trading year, it did close below the 200, and I had to get out for a loss, like I mentioned, of 6.5%. Now, there's a lot of potential levels here. This is a monthly trade, so I would have to wait till the end of January to take this, but look, we have the 250, we have the 300. Those would be potential levels to key off of. Or if it just closes back above the 200, then I could get in there as well. But just wanted to make the point, this had more confluences, entry signals than about anything I've seen in a while, but it still didn't work out. So you still have to take your losses, position size correctly, and have the discipline just to get out when your approach tells you to get out. So those are the trades. Not too bad. And it was nice to see that we had a recovery in the last hour on Friday. I don't know if that's going to translate to anything going forward next week, but at least it was a good sign. And, at the end of the year, especially this kind of year, people do have tax loss selling. And I think we saw some of that in the last week of this year. And now that the year's over, that will not be applicable anymore. So hopefully we'll have a rally, but you never know, right? All you can do is just follow your plan. Okay. All right. As I mentioned, I want to do a little bit on trading psychology. This is from my good friend Thomas Payne. You can follow Thomas at Trader T Payne. Great trader. He was a scientist, and he switched careers and became a trader, and he really brings the scientific method from him being a scientist into trading, which I think is great. And he's replying to Nick Schmidt here at Nick Schmidt _. Trading is all about making quick decisions based upon incomplete information. And no matter how much experience we have, we can never know everything. That is 100% true. And Thomas replies, knowing more information does not always help your trading. The information itself doesn't matter. How people react to the information is what matters. That is reflected in price action. And I could not agree anymore. So what does that really mean? Well, I'd like to caution you away from listening to analysts and listening to the news. I remember at the beginning of 2022, I was listening to some analysts saying, well, fundamentally, based upon the fundamentals, we should go up 30% this year. Not really even close. As a matter of fact, the opposite, right? And so, you get people on TV, they wear nice suits, they speak well, they can make good cases, but what Thomas is saying here, I mean, that's information they're giving you, right? Knowing more information does not always help you trading. The information itself doesn't matter. How people react to the information is what matters. This is reflected in price action. So the whole point here, Base your trades based upon what is happening in the market, based upon what is happening with price action. That is the only truth in trading. You may have a company that has good earnings, but it goes down. How can that be? Doesn't matter. It's that it went down. You may have a company that has really bad earnings, but the shares rally, right? That's the truth of what is going on. So, just to wrap this up in a nutshell, don't listen to analysts. Don't listen to pundits talking about what they think the market's going to do. Base your trades upon what the market is actually doing. That's the truth, not the narratives, not the stories, not the hype, but what the market is actually doing. All right. And, I have students, they ask me, hey, Greg, do you trade on news? I'm like, no, I do not trade on news per se. I trade upon the levels. And if the news is good and it brings it up above a level, well, yes, then the price confirmed. So, a lot of people try to trade on news, they listen to analysts, but my recommendation and what I do is based upon what the price actually is doing. So thank you, Thomas. Please follow Thomas at Trader T Payne. He always has great information. All right, let's do a poem for my good friend Frank. You can follow Frank at Franco D. He's the trading poet. And today's poem, of course, is pertinent because it's the end of the year. The year comes to an end, and what a message it did send. Big name stocks like ships turned over on their ends. Cash on the barrel, high rates from those who lend. This was a year for traders to maneuver, duck, and bend. Yeah, great poem, Frank, and it's true. This was not a good year in the market. Going out next year, it's potential that the Fed could stop raising. It's the potential that the Fed could become more dovish, and of course, if that happens, most likely there will be a rally in the market. But as I just mentioned in the psychology section, the rally will show up in the charts, right? And that's what's important. So one more time. The year comes to an end, and what a message it did send. Big name stocks like SHIP turned over on their ends. Cash on the barrel, high rates from those who lend. This was a year for traders to maneuver, duck, and bend. Thank you, Frank. Appreciate that. Hope you have a good 2023, and always appreciate the effort that it takes to write these poems. All right, let us head over to the potentials that I see for next week. I'm going to first go over the potential daily trades. Okay, so at the beginning of the podcast, I was talking about V1s and V2s. And one of the approaches that one of the strategies that I teach in my one-on-one lessons is called a return to value V1 or V2. I love these trades. They don't happen a lot, but Alibaba, BABA, is setting up for that. Let me point out, here is this green line and this green line. This is the 1 ATR channel. This is the negative 1 ATR channel. Any place in this band between this top green line and this bottom green line is considered the value zone. And when I studied with Dr. Alexander Elder, what he told me is, Greg, most amateur traders buy above the value zone, buy above this green line. And it's generally not a good idea. What you want to do is you want to buy something in value, like it is now, and sell above value. Most retail traders like to buy above value, and then when it comes back down, they get stopped out in value, which is exactly really the time you want to look at buying. Or conversely, you want to buy below value, like an under 30, over 30, a 200, a deep dip buy on the 200, 250, or 300, and then sell when it gets back to value. So you want to buy in value, sell above value, buy below value, sell in value. Make sense? So a return to value setup the price action has to first be above value, and anything above the green line here is above value. So this was above value. I don't want to be buying it up here, but you see how now it's returned to the value zone? This is the value zone. So now we're back in value. So we've returned to the value zone. We've had all sorts of sideways motion, which is important because sideways motions lead to trends. And conversely, trends lead back to sideways motion. This is a perfect example. See, the trend led back to the sideways motion. Sideways motion leads to trends, either up or down. We don't know that. But so we were above value. We've come into the value zone. We have sideways motion showing there's an equal amount of buyers and sellers. Now all I'm looking for is a V1 or a V2 entry. And again, there's a link in this description of my YouTube videos on V1s, V2s. But this is great. So what I'm looking for next week on Alibaba is some kind of washout below a previous bar's low, and then a reversal back up showing that it tested the waters. There were no more sellers, and a reverse back up. Then it's more likely to go up. And of course, in my one-on-one lessons that I teach, we go through this extensively. So I can't really show you exactly with this chart how it could potentially. There is not one right now. But let's just say on Monday or Tuesday, because the market's closed on Monday, here's the most recent bar. Let's say we went below the low and then closed back above the close. That would be a V1. Or conversely, a V2 is if Tuesday we went lower, didn't rally, but then Wednesday we rallied back up and closed above bar one's close. So looking for, it's a beautiful, return, nice trend up in an uptrend, sideways motion, and now looking just for a V1 or a V2 entry. Berkshire Hathaway. Okay, well, something to notice, excuse me, on Berkshire Hathaway is we did have a 50 crossing over the 200. That's called the golden cross. That's a good long-term moving average crossover. But I'm not going to just buy it based upon that particular crossover. What I'm really looking for here on Berkshire would be come back and test the 200 moving average, especially in conjunction that this golden cross just happened. A lot of times when golden crosses happen, you do get a bit of a pullback, strangely and ironically enough. But I've noticed that if you do get a 50-200 crossover, that if you do have that initial pullback to the 200, after the crossover initially happens, that's a really great place. And I would buy based upon some kind of rejection of this 200 here, regardless if we had a golden crossover or not. But having the golden crossover in conjunction with that makes it look better. And you can see the 200, we had a close under, close over. It's held that. That would have been a nice profitable trade just based upon the 200 as well. So I don't know if Berkshire Hathaway is going to get back to the 200 next week, but if it does and it rejects it, and by rejecting, I mean either it closes under, closes back over, or it has an intraday rejection, or it has a bounce. Either of those, any of those three would be valid. So don't know if it's coming there, but if it does, that is where I will enter the trade. And it's a good time to point out that, in this podcast, what I try to do is show you the levels that I'm waiting for. But the key is don't do anything unless they get there. So if Berkshire Hathaway rejects the 200, yes, I will get in. If it doesn't, then I'll just find something else that does. Dow Jones. All right. Well, same thing. I am looking for, this was actually a legitimate entry on Friday. This is the 250. Do you see how we rejected it? We went under and then closed back over. Oh, and I didn't notice here. Oh, might as well put that there. Let's see. The close here is 332.06. I haven't talked about V1s and V2s for so long, so maybe something's changing. This is again another strategy that I teach in my lessons. Just before I talked about the return to value V1 or V2. This is called a higher low V1 or V2. We closed below the -1 ATR channel. We rallied into the value zone, and now this is potentially setting up Monday for a higher low V2. Here's bar 1. Bar 2 goes below bar 1's low. If Monday, but not Monday, excuse me, Tuesday. If Tuesday we close above bar 1's close, this would give us a higher low V2. I didn't notice that when I was prepping for the show. So it would give us a higher low V2 if we close above bar 1's close. Here's bar 1, bar 2. Bar 2 goes below bar 1's low, and Tuesday only, If we close above bar one's close, that would give me a higher low V1, V2 in the entry in the value zone, and these have to take place in the value zone. So yeah, I'm surprised I didn't see that, but I see it right now. So if we close above 332.06 on Tuesday, that will get me long on a higher low V2. Conversely, if we come back down, test the 250, maybe give me a little better risk to reward ratio, that would be an entry. Or of course, if we go lower and we have a rejection of the 200, I would also get long with the rejection of the 200. So lots of potentials here next week for Dow. Again, if we close above 332.06, that will give me a higher low V2 entry. I would certainly consider taking that. If we reject the 250, again, with a better risk to reward ratio, I would take that. Or again, if we reject the 200, that would also be a place for me to get long Dow Jones. FCX, okay. A lot of hot V1, V2 talk here today. This is a return to value V1, V2. We were above the value zone. We came back into the value zone. We have some nice sideways motion. Okay, those are all the requirements. Above the value zone, into the come back into the value zone, sideways motion, sideways motion, sideways motion, and we are potentially setting up on Tuesday for a V2. Here's bar one. Bar 2 goes below bar 1's low. If on Tuesday we close above bar 1's close, which is 38.31, that will get me long on FCX. And again, go to my YouTube channel, watch the videos on V1, V2. They are completely free. Or alternatively, of course, you can study with me one-on-one. And we do a lot of simulation trades and show you this. But I can tell you that return to value V1s are one of my very favorite setups. So nice potential for a V2 on Tuesday if we close above 38.31. Home Depot, the same. Higher low V1, V2. This one closed below the -1 ATR channel, has rallied into the value zone, came back, tested the -1 ATR channel. So again, this is only for Tuesday, but if we close above 320.41, that would give us a V2. Here is bar 1. Bar 2 goes below bar 1's low by a quarter ATR. And if we head back up and close above bar 1's close at 320.41, it would give me a higher low V2 entry, and I really like higher low V2 entry. So that's what I'm looking for, but again, only if it happens on Tuesday. Southwest Airlines, well, they've been in the news last week because of all the storms and all the delays. We did have a valid signal on Thursday because we went under 30 and then closed back over 30. So that was a legitimate signal, and that legitimate signal you would have already been up 0.87%. I'm not going to chase up here at a 36.59 RSI, but next week, and this was such a big down move, and we've had a little bounce. I wouldn't be surprised to have it come back down and test the 30 RSI again. And if it did test the 30 RSI again, most likely it would be a higher low test. And I always like higher lows better than lower lows, whether that's 200, 250, 300 using the RSI. But this, of course, came from a lower low, under 30, over 30. If next week we come back down, test the 30 again, and then reject it and go back up, that would be a higher low, under 30, over 30, which is much more desirable than the lower low. But who knows, right? Again, if it happens, I'll take it. If it doesn't happen, I'll just trade another market. Morgan Stanley, well, that 200 right there. Is it going to act like a magnet? It may, and I will take it, but I will only take it if it gets there. Right, here's the 200. So if we have a close under, close back over, I'll get long. If we have an intraday rejection of the 200, I'll get long. If we have a bounce at the 200, I will get long. I wish there was a double bottom bullish divergence here, but there's not. So that's definitely something to consider. Let's take a look at the larger time frame, see if there's any support. Yeah, there is actually. Excuse me. Right now it is holding at the 50. See, on the larger time frame, holding that 50 is a good idea. But if we come back down on the daily to the 200, it will have lost that 50, right? So that's something to consider. But nonetheless, I would still buy Morgan Stanley. If we come down next week and reject that 200, that would be my entry. And if it doesn't get there, I'll just trade another market. Pfizer, another perfect example of a return to value V1 or V2. Here's the value zone, the two greens. Of course, we were above it. We've come back down into the value zone as we always do. We have some nice, beautiful sideways motion showing there's an equal amount of buyers and sellers. This almost created a V1 on Friday. Here is bar 1. Bar 2 goes below bar 1's low, but it did not close above bar 1's close. So that is not a V1. However, if a V1 fails the next day, and again, this only goes for Tuesday, if the next day it closes above bar 1's close, 51.33, that would get me long with a perfect return to value, sideways motion, V2 entry, but only if it happens on Tuesday. Conversely, if it comes down, test the 200, then that would be another spot that I would looking for. So, and this is a good example of it either has to move up to get me long or it has to move down to get me long. And here, look, we have a 50 200 crossover. So we have a golden cross, right? We have a golden cross here. So we also have the 300. We also have the 250. So if it closes above 51.33 only on Tuesday, it will get me long with return to value V2. And I can also, if it goes down, look for rejection of the 300, the 250, and the 200. Tesla. Well, I already took Tesla, and you know why on the weekly bars with the rejection of the 300-day moving average, 300-week moving average. But we are getting very close to a legitimate entry on the daily on Tesla with the close over the 30 RSI. We're at 29.82. If we move up on Tuesday, then it will put us back above 30 RSI, and that is a valid signal. And depending how far it moves up, we might also close back above the negative 30 ATR channel. That would be a nice confluence. Of course, I would like that. Closing back over 30 RSI and the negative 30 ATR channel would bring some buyers in, and of course that would help my weekly trade as well. So hopefully that happens. But if I was not long Tesla on the weekly, then I would look to get long Tesla on the daily if and only if we close above the 30 RSI, and it's very close. The dollar. Well, the dollar has really fallen off a ledge here. And it all started back here with this abandoned baby. An abandoned baby is when you see how this bar is just by itself. That's why they call it abandoned. There's a gap to the left and also a gap to the right. That's very bearish. That is extremely bearish. And you can see it really was bearish, wasn't it? Now, I would love to see an abandoned baby to the upside on UUP. That would be a high probability trade, but I don't see that happening here right now. Hard to see those coming. You can only see them after the fact, but I am looking for UUP. The dollar has moved down significantly, so I am assuming that we're either going to go up or down next week. If we close back above this 250 on the daily, then I could get long the dollar. I could get long the dollar if it closes above the 250. Conversely, if it goes down and we reject the 30 RSI, that would also be another level for me to get long. Or if we get it even down here to the 300, that would also be another level. One thing I do want to mention here is that we have a double bottom bullish divergence. See how we have a low here with deep red MACD bars, and then we rallied to some green, and now we are actually even lower than over here. But you see how there's no red bars? That's called the double bottom bullish divergence with a missing right shoulder, and that's the strongest divergence setup that I use. And again, this is something I teach all of these in my one-on-one courses, but I am seeing a lot of potential in the dollar here because of the double bottom, bullish divergence. But even though that's the case, I still need some kind of signal. And again, the signal would be a close over the 250 next week. That would get me long. If we go down and we go under 30 over 30, that would also get me long. Or conversely, if we reject 300, that would also get me long. But in the context of the double bottom bullish divergence, it makes that even stronger. Okay, last one on the daily is XLF. Well, this was a legitimate entry signal actually even 2 days ago. Here's the 200 week or the 200-day moving average. Notice we have a 50 200 cross. That's the golden cross I talked about. And you could have gotten long on Thursday with a close above the 200. You would be in the money. And this is also on Friday. This is also a legitimate entry with a rejection of the 200. Now, I did not take this trade because I took Tesla instead. But I will look next week for some kind of close under, close back over. This close under over 200 came from a lower low situation because we were lower here, we closed back above. It's legitimate and it would have been profitable so far, but what I would be looking for is a higher low close above the 200. If we came down on Tuesday and then Wednesday we closed back above the 200, this low would have been higher than this low. So that's really what I'm looking for in XLF is simply a close under the 200 and then close back over the 200, making it a higher low situation. All right, so those are the dailies. Let's switch over to the weeklies now. And again, these are weekly trades. Weekly bars close on Friday. So at the close of the bar on Friday is where I will make the decisions. Okay, this is AGQ. This is double leverage silver. I am looking to short this, not go long. And my target would be a rejection next week, next Friday. If we had rejected, we'd gone above this 200 and then closed back below, that would be my area to get short. And going short's just the same, position size the same. All you do is you put your emergency stop above, and if it did reject the 200, then my end of day stop would just be a close above the 200. Now, again, I like to look at multiple time frames. If we look at the monthly, because if I'm trading the weekly, the higher time frame is the monthly, and there is a lot of resistance above here. You have some gaps here, which is one component. You also have the 50-month moving average. You have the you have the 100-month moving average. These are going to be some significant levels of resistance. Doesn't mean they can't just blow through them. But again, I like to look at the monthly, or I like to look at the higher time frame to look for some strategic resistance levels and then take the trade on the smaller time frame. In this case, would be the 200-week moving average. And if it gets there and rejects it, yes, I will get short. If it doesn't, again, then I will just get on to another trade. You know, one thing I've noticed here and why I am kind of bearish on silver, you see the abandoned babies here? See the two bars here, the gap to the left, the gap to the right? That's bearish. That is bearish. Doesn't mean it has to move down immediately, but longer term, I think that's bearish. And actually seeing this bearishness on the metals makes me believe more confidently that the market is near a low, right? You kind of have to look and overlay them on. But, you know, silver has been very strong while the market has been weak. So if silver becomes weak, you can make a case that the market will be strong. And this abandoned baby here is what brought my attention to looking for a short on this trade, but I still need a valid signal, and the valid signal would be a rejection of the 200-week moving average. Amazon. Okay, well, Amazon, of course, has lost about 50% of its value this year. Pretty tough. of course, if interest rates are rising, people have less money. There's less money to be spent on Amazon, and therefore their earnings are going to be less. And that's why the market has discounted that information in, and look at this move down. Now, can it keep moving down? Yeah, of course, it can keep moving down. Um, but my signal, we're getting close to the negative third ATR channel. My signal simply on Friday would be a under 30 over 30. That's it. If we reject the 30 RSI on the weekly, but then close back above it, that would give me long. Doesn't mean it has to bounce from there, but it does give me a good risk to reward ratio. And the under 30 over 30 confirms to me that there were no more sellers under 30. So it's not there yet. Don't know if I'll take this trade. I would like to get long Amazon, but I have to wait for my requirements to get long. And right now, my requirements would be an under 30 over 30. Now, want to point out again, double bottom bullish divergence here. See the lows we have here with the deep red MACD bars? Pretty deep. Then we rallied into green. That's the second requirement. Now, are we lower here than over here? We certainly are. Is the MACD as deep as over here? No, it is not. So that is what is giving me an indication that we may be running out of sellers. But just because we have a double bottom bullish divergence in place does not mean that I just take the trade. I still need confirmation from the price action. Under 30 over 30 would get me there. And again, these are all the things in my one-on-one courses that I teach, and we go over this ad nauseum. I promise you. I promise you. All right. DoorDash. DoorDash, well, we were talking about V1s, V2s. Well, this is a perfect potential setup for next week for a higher low V2. Requirements on a higher low is that we close below the negative 1 ATR channel. We rally into the value zone. We have a bit of a pullback, and then we have a new group of buyers coming in here, which would be indicated if we had a V2. Here is bar 1. Bar 2 went below bar 1's low by a quarter ATR. Also rejected the negative 1 ATR channel, which I really like. But next week, if we close above bar 1's close, that would give us a higher low V2. See, this low is higher than this low. MACD is green. I also like that. So there's a lot of things going on here as Saturday morning when I go through my watch list, I get a really good objective feel of what the markets are doing. Not so much during the week, but on Saturdays or the weekends when I do the podcast, I do get a pretty good objective feeling of what's going on here. And if we do on DoorDash, DASH, if we do close above next week on Friday above 50.69, then that will be a beautiful higher low V2, give me a good risk to reward ratio. And I love higher lows. Higher lows very often are the beginning of a new trend. And if you're wrong, well, you're wrong quickly because you have a good tight stop. And if you're right, then you have the ability to have a really great trade. And that's what it's all about in trading. Good risk to reward ratios at levels. If the levels hold, fantastic. If they don't, then you can get out quickly. You've already adjusted your position size. You've put in the worst case scenario. That's what trading's about, everyone. And more importantly, you have to have a process of what to do if it goes up, right? You can't just go, I think it's high enough and get out, right? Like you have to have a process. And in my 28 years of trading, the process of scaling out, using trailing stop levels, that's really, I think, what makes the difference between a real profitable trader and someone who's not. And again, that's everything that I just mentioned there is what I do teach in my one-on-ones. Etsy. Etsy did bounce at the 200 here. I did not take that trade. If I did, I would have had to have gotten out here. But next week, if we close above the 200, it would give me a higher low close above. Here we went from a lower low and closed above. Well, it didn't work out so well. But if we close above the 200, that will give me a higher low close back above the 200. And so that's what I would be looking for next Friday on Etsy if we have a close above the 200. NVIDIA. Ooh, I've really been watching NVIDIA, and I would love to buy NVIDIA here if by next Friday we reject this 200. Here we had a lower low, close above, under, closed back over, and had a beautiful trade just based upon that. You would have scaled out, it would have been great, you would have gotten out half here, but a nice profitable trade. But again, I like higher low closes on 200s, 300, 30 RSIs, 300s, 250s. And so NVIDIA, I'm just waiting. I'm just waiting, quietly stalking. If we come back down, test that 200, I will get long NVIDIA for sure. The Qs. Well, QQQ on the weekly, two potential things happening here. Either it moves up higher to get me long or it moves lower to get me long. Right now, it's just kind of in no man's land. If we go up close above the 200 next week, yes, that would get me long Qs. If we go lower and reject the 250, that would get me long the Qs. Ideally, I would rather pick the 250 because it's lower. And look, again, everyone, double bottom bullish divergence. Look, here's a low, deep red MACD bars. We rally into green. We come back down. We go lower than the previous low. Do you see how the MACD bars are not as deep as the first low? Implication, we're running out of sellers, and the implication of that is that we're going up, but we still need the price action to confirm that. And again, if we go lower, reject the 250, absolutely would get long the Qs. If we go higher, close above the 200, that is another option. SSO, which is double leverage Dow. This is very interesting to me. We did have a close under, close over the 200, and then it failed. Then we had another close back over, and that one went up for a bit, failed. But it is quite likely that if we have any kind of rally next week, we will have a close above the 200. And so on Friday, if it closes above the 200 on the weekly, that would get me long. Conversely, if we come back down, reject the 250 or the 300, that would also get me long. Boy, I don't think I've talked about V1s and V2s so much ever than in this podcast, because this year we just haven't had a lot of them. Well, this is weekly, this is bonds, and I really do hope this triggers next week, because if bond prices go up, that means interest rates are coming down, and that would be good for the market as well. Had a really great trade here on TLT, just simply with an under 30, over 30, and a rejection of the negative third ATR channel. And that was a beautiful trade that I took. But now, and then I'm out of the trade now, but this is a setting up for a potential higher low V2. Requirements of a higher low V2, we close below the negative 1 ATR channel, no problem there. We've been below that for a long time. Then we rally into the value zone. Yes, the people that got long down here, like I did, sold here when it started to get weak. And that's what caused this second move down. Now, this is formatting next week for a V2. Here's bar 1. Bar 2 goes below bar 1's low. If we close above bar 1's close next week, that will give us the higher low V2 in the value zone. So next week on Friday, if bonds close at over 102.16, I will definitely consider getting long, depending, if it closes this high up here, no, I would not, because then the risk to reward ratio is kind of skewed, right? But if we have a nice gentle close above bar 1's close here at 102.16, that would be a beautiful higher low V2. Conversely, if we gapped up here, then this would be an abandoned baby to the downside, which would also be very bullish for TLT. And so again, next week on Friday, if we close above 102.16, not too far above that, that would get me long TLT with a higher low close in the value zone. And then last but not least here, VIX. VIX is at a 29.39. I did take a trade a couple weeks ago where it went under 30, over 30, and then closed back below. That got me out of the trade for a loss. But, VIX has been kind of consolidating here, dripping down a little bit, but consolidating here. And if we get a close above the 30 RSI, that would get me long. So at the beginning of the podcast, I talked a little bit about my one-on-one course. Listen, if you want to learn how to trade the best, whether you want to learn how to trade or play tennis or swim or golf, whatever, it's always best, in my opinion, to have someone that you can work with one-on-one. And that's why I have these courses available, the one-on-one courses. Sometimes in a group setting, people are embarrassed to ask questions, but when it's one-on-one, you just ask as many questions as you want to. And in that course, the 15-hour course that I teach, we go over all 5 of the different trading approaches that I use. I teach you step by step. It's very important to me that my students succeed. It's, for my brand, and I just want people to succeed in trading. And if you take my course, you take it seriously, and you follow what I teach you, you're going to have a pretty good dang chance of making some money in this market. I've been trading for 28 years, and everything I've learned over those 28 years is what I share in that course. So if you are interested, my email is in the link in the description. Reach out to me, say, Greg, I'm potentially interested in taking your course. I'll write back and say, great, let's set up a Skype call. The Skype call's free. It's not a sales call, I promise you. I have lots of students, right? But it's just a good time for me to learn more about you, your trading goals, your trading challenges, what you hope to achieve. And then it's a great time for you to ask me any questions about the course. And when we're done with that call, then it's totally on you. You can think about it as long as you want. But if you wake up one day and you say, hey, today's the day that I want to go through this course with Greg, then just reach back out to me. We'll get it set up and away we'll go. The course does cost $1,750, but it's worth every penny. I promise you, I have turned out some great traders around the world, and I hope to do the same for you. If you like online courses, I have a great online course available at udemy.com, and the link is in the description of this YouTube video, where I teach you step by step how to trade the deep dip buy stock trading strategy. And a lot of the trades that I've had in the last couple months have been these deep dip buys, and it's a great course, and it's super affordable. It's only $12 or $15. And don't let the low price fool you, because there's so much content there. There's 9.5 hours of video. There's 26 videos total. There's 15 different study guides. And it's a great way to start learning how to trade the deep dip buy. We go over position sizing. We go over trailing stops, partial profits, emergency stops, overhead resistance levels, all that stuff. So, if you have some time this weekend, get it. I've sold so many across the world. And I've got such good feedback and reviews on that course. So the link's in the description. If you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It does help YouTube know that there's some valuable content here. If people hit that, it only takes a second and it's totally free. So if you did find some value here, I would really appreciate it if you could just take the time, hit that thumbs up button, and or maybe share this podcast on your social media as well. That would be great as well. And then lastly, and always most importantly, please try to go out and do something nice for another human being today. It would just make the world such a better place if we could all do one nice thing for another human being. And of course, a lot of you know I'm a big animal lover. I would really appreciate if you could go out and do one nice thing for an animal as well. So that's all I ask. One nice thing for another human being, one nice thing for an animal. It's good for them. It's good for you, good for your soul, and it would just make the world a better place. And, Tuesday is the first day of 2023. I wish you all the best luck in 2023. And I would like to say, if you've had a bad 2022, like a lot of people have, 2023 is a great time to really get your act together, really position size correctly, be patient, wait for the correct trades, and get yourself started with a good habit. Get that first week and follow the rules exactly. And the longer you do it, the more it's going to become a positive habit. And that is what's going to affect your results in 2023, is really following your rules. Whether we're going up in 2023, I don't know. I think the Fed will soften its stance, and of course the market will like that. But whether that's in February or March or April, it's hard to know. So again, just follow what the price action is telling you. If you have any questions, please feel free to leave them in the comment section. I'll do my best to get to them. But I wish you the best health, happiness, prosperity, great trading in 2023. I appreciate you coming here, spending the time. I hope that by spending the time, it is helping your trading. That was, the whole reason that I did start this podcast. And so I think that's it, everyone. On the way out, I have to run the U.S. legal disclaimer. But thanks again for your time. Thanks again for investing your time here. And good luck to all of us in 2023. And God willing, I will see you next weekend. And we'll go over the trades that I took for the coming week. All right, everyone. On the way out, I have to run the U.S. legal disclaimer. Happy New Year's. And hopefully we'll talk to everyone soon. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.